What if you could manage every aspect of your financial life? Your loans, your savings, your investments, and your daily spending, all from one single app. For years, the banking industry has been fragmented, forcing consumers to juggle multiple institutions. But one company, SoFi Technologies, has successfully built the digital one-stop shop designed to guide its members toward total financial independence. SoFi Technologies, once written off as another overhyped SPAC that would never make money, has transformed from a student loan refinancing startup into a full-stack financial services platform, generating nearly $1 billion in quarterly revenue and achieving net income for the first time in 2024. The stock is up more than 200% since April's lows. Q3 results crushed expectations, a triple beat on revenue, EBITDA, and earnings per share. Management says they've never been more optimistic about the company's future. But here's the catch. The stock is trading at 85 times forward earnings. That's not a typo, 85 times, while traditional banks trade at 11. Is SoFi the future of banking, or is this valuation completely insane? This is the story of SoFi Technologies, how a social lending experiment became a bank license platform with 3 engines. Welcome back to the Capital Navigator, the channel where we explore the history, strategies, business models, and investment opportunities of the world's most influential companies. We'll cover SoFi's origins and transformation, its 3-segment business model, and the financial services productivity loop that drives cross-selling. The impressive financial turnaround from losses to profitability, the volatile stock performance, the risks investors face, and what the future holds for this ambitious fintech. Let's begin. The origins, from student loans to financial super app. The story of SoFi, short for social finance, is one of academic ambition and strategic pivots. SoFi was founded in August 2011 by 4 Stanford Graduate School of Business students, Mike Cagney, Dan Macklin, James Finnegan, and Ian Brady, with a simple idea: alumni fund better-priced student loans for younger grads. The initial concept was based on social lending, connecting recent graduates with alumni willing to finance loans at lower rates than those offered by the federal government. It was a clever idea. Leverage the Stanford alumni network to provide better rates than the government. And it worked. Based on its initial success in student loans, SoFi rapidly expanded its credit offerings, introducing mortgages and personal loans in 2014. By September 2015, the company had already originated $4 billion in loans. The arrival of Anthony Noto as CEO in January 2018 marked the beginning of a fundamental transformation, focused on moving from being just a lender to a comprehensive financial services platform, the one-stop shop. He drove the core strategy known as the Financial Services Productivity Loop, which we'll talk about in just a moment, designed to build a long-lasting relationship with members through extensive cross-selling of multiple products. A key structural moment arrives in June 2021. SoFi closes a SPAC combination with social capital head SoFia and lists on the NASDAQ, followed by securing a national bank license in 2022. This was a core element of SoFi's long-term strategy, drastically improving its unit economics and cost of funding, allowing it to use lower-cost member deposits to fund loans, replacing expensive wholesale financing methods such as warehouse facilities. By late 2023, it posts its first profitable quarter, a psychological and strategic turning point for a company long dismissed as growth without profits. The business model, the financial services productivity loop. SoFi's business model is that of a comprehensive financial services platform, member-centric and designed to build a lasting and profitable relationship throughout the customer's financial life. The company structures its operations across 3 interconnected reportable segments: lending, financial services, and technology platform. Lending segment. Historically, this has been SoFi's largest and most profitable segment, contributing approximately 55% of the company's total revenue. Products include personal loans, student loan refinancing, the company's origin, school and mortgage loans. Income is derived from net interest on loans retained on the balance sheet and from origination fees on loans that are sold or securitized to outside investors. Financial services segment. This segment is often used as the tip of the sword for member acquisition, as its products generate daily interactions. The suite includes high-yield SoFi checking and savings accounts, formerly SoFi Money, the SoFi credit card, the SoFi Invest platform that offers active trading, robo-advisory, and digital assets, and SoFi Relay, a free personal finance tool for account tracking and credit monitoring. Revenue comes primarily from interchange fees on debit and credit transactions, brokerage fees, and digital asset transaction fees. In 2024, this segment contributed roughly 30% of revenue. Technology Platform Segment. This division is the crucial B2B arm that provides core technological infrastructure to other businesses. It currently accounts for about 14% of the company's revenue. Key products includes Galileo, a platform providing API services for payment processing, card issuing, and account handling, and Technisys, a cloud-native digital core banking platform that allows clients to develop and offer financial products more quickly than with legacy systems. The combination of Galileo and Technisys allows SoFi to vertically integrate more of its own financial services, which significantly reduces operating costs. A key part of SoFi's business model relies on the financial services productivity loop. The cycle works by capitalizing on the trust built through one product to sell additional products at a near-zero marginal cost of acquisition. The cycle works as follows. Member acquisition. A customer joins the platform through a specific product, often a loan or high-yield account. Trust building. SoFi seeks to offer superior user experience and high-quality products to generate trust and loyalty. Cross-sell. Once the relationship is established, the company offers additional products from the SoFi ecosystem. This is done at marginal acquisition cost, as the member is already on the platform. Higher lifetime value. Each additional product increases revenue per member. In Q4 2023, approximately 43% of loan originations came from existing members. Reinvestment. Higher profits are reinvested in improving member benefits and product experience, thus reinforcing the cycle. When it works, this loop improves unit economics across the board. Deposits fund loans at lower cost, lending profits fund product improvements, and the tech platform lowers SoFi's own cost while generating external revenue. The numbers, the path to profitability. The last 3 years mark SoFi's transition from a company with significant net losses to an entity with positive GAAP net income for the first time in 2024, validating its integrated business model. Revenue has growth from $1.57 billion in 2022 to $2.67 billion in 2024. That's a 25% growth rate for the last couple of years. Impressive for a company this size. Net income has growth too, from a loss of $320 million in 2022 to a $499 million profit in 2024. That's the game changer right there. SoFi achieved its first full fiscal year with positive net income in 2024. Gross margin was around 80%, and net margin was 18.7%. These are software-like margins for a financial services company. Performance in 2025 continued the trajectory of profitable growth, with notable acceleration in non-credit revenue growth. For Q1, the company's reported revenue was $772 million, increasing to $855 million in Q2 and $950 million in Q3. Similar behavior for net income, going from $71 million in the first quarter to $139 million in the third quarter this year. During the result presentation for Q3, management emphasized they had never been more optimistic about the company's prospects, citing the solid foundation to benefit from AI and blockchain supercycles. The company also exceeded EPS expectations by 30 cents, posting earnings of 11 cents per share. With this, SoFi raised its full-year forecast. Revenue raised to approximately $3.54 billion, above previous guidance of $3.3 billion, and adjusted EBITDA raised to approximately $1 billion, exceeding previous guidance of $960 million. These impressive numbers and positive company expectations have been reflected in the stock's behavior, which is what we'll look at now. Stock performance, volatility, and the rally. SoFi went public through a SPAC merger with social capital head Sophia Holdings Corporation. The behavior of company's shares since its IPO has been extremely volatile, characterized by a strong initial decline followed by a spectacular recovery, driven by achieving profitability and validation of its integrated business model. The year 2022 was extremely difficult for the stock, largely due to the market's aversion to high-growth fintechs that didn't generate profitability. The stock collapsed along with most SPACs and unprofitable tech companies as interest rates rose and the market rotated away from growth. The narrative changed dramatically in 2023 and 2024, driven by demonstrating business model profitability. In 2025, the stock has maintained a bullish trend, reaching new highs, though with significant short-term volatility. It reached new highs above $30 in September 2025. Towards October, the stock was in a consolidation period, though it is up 100% year-to-date. And here's where things get controversial. Current investor and analyst opinion on SoFi is polarized, characterized by strong optimism about its fundamentals and growth potential. Optimistic analysts see SoFi as a leader in the fintech revolution that has validated its business model and believe the stock still offers long-term growth potential. Counterbalanced by extreme caution regarding its elevated market valuation, pessimistic or cautious analysts focus almost exclusively on the company's valuation and latent credit risks. SoFi trades at valuation multiples well above its financial sector and fintech peers, with a forward price-to-earnings of around 85 times compared to the financial sector median of approximately 11.5. The current price demands impeccable execution and has already discounted years of future growth. Any stumble in growth, credit quality, or competition could trigger a sharp multiple contraction. The lending business, the main profit generator, is heavily concentrated in unsecured personal loans. While credit quality has been good so far, the portfolio is vulnerable to the economic cycle. The recent sale of 71.9 million common shares to raise $1.5 billion in July 2025 generated concern about dilution and caused shares to fall 6.5% after hours. The stock is trading at premium valuations that leave little room for error. The future. What's next for SoFi? Looking ahead to the near term, SoFi plans accelerated investments, re-entry into the cryptocurrency market, and improved user experience. Crypto and blockchain launch. Re-entry into the business of buying, selling, and holding a selection of cryptocurrencies is planned for the end of 2025. The company is also developing the SoFi stablecoin strategy, which will be used as a faster, cheaper, and more secure means of transferring economic value between SoFi and crypto-centric businesses. New lending products. The launch of new personal and student loan products, such as the Smart Start solution, allowing for lower initial payments, is planned to further penetrate the lending market. So here's where SoFi stands today. This is a company that started as a student loan refinancing platform in 2011 and has transformed into a full-stack financial services ecosystem with 8.8 million members, 3 distinct business segments, and a proven path to profitability. The transformation under CEO Anthony Noto has been remarkable, from losing hundreds of millions annually to posting 8 consecutive profitable quarters. From a single product lender to a one-stop financial shop with lending, banking, investing, payments, and B2B technology services. The financial services productivity loop is working. Cross-sell is happening. 43% of loan originations come from existing members. The technology platform is providing infrastructure for other fintechs while reducing SoFi's own costs. The bank charter transformed the unit economics. Q3 2025 results were spectacular, a triple beat with management raising full-year guidance significantly. Revenue growing 36% year over year. EBITDA hitting record levels. The business is firing on all cylinders. But, and this is critical, the stock is trading at 85 times forward earnings. That's not bank-like valuation. That's not even typical fintech valuation. That's growth at any cost, perfect execution required valuation. For investors, SoFi represents a clear trade-off. Incredible growth and execution versus stretched valuation. This is not a value play. This is a growth story where you're betting on continued execution and market share gains in a massive market. What do you think? Is SoFi a revolutionary fintech leader set for multi-year dominance? Or is its current valuation an accident waiting to happen? Let me know your thoughts in the comments below. And if you found this analysis valuable, smash that like button and subscribe to the Capital Navigator. We break down high-growth companies like this every week, giving you the insights you need to make informed decisions in today's market. I'll see you in the next one.